The Financial Sense Friday edition with Jim Paplava. Focusing on precious metals and mining.
Welcome to the Friday edition of the Financial Sense Newshour daily program, and this is usually our metals report. John Lufter sitting in the hot seat for the first part of the program. Jim Paplava will be here in the second part. A lot of interesting changes going on in the market. Brent Cook is joining me for the first part of the program today, and I've noticed that the junior market seems to now be coming out of favor. Looks like for some of the appetite for risk in the metals area is dissolving, at least for now. What would you attribute that to?
I think, you can point to a lot of reasons, but number one is that I think the people who've been funding the junior exploration companies and such over the past, call it year and a quarter, to the tune of $7.5 billion on the venture exchange alone, are starting to recognize that this is, in fact, a very high-risk business. And the prices that these companies are being valued at assume a lot of success, which just doesn't happen. So I think that's coming into the picture. That $5 billion is also coming out of the 4-month hold period, hitting the market. And the gold price is down a bit. Silver's certainly down a bit. It's just been too good for too long. So it's correcting for those reasons, I believe.
Yeah, and everybody knew that just silver in general was going to have to make some correction in here, even though the long-term prognosis for a continued bull market in silver still exists. Let's face it, sooner or later, there is going to be more quantitative easing or something along those lines that'll drive it up again.
I would assume so. I'm not sure how it's going to come or what it's going to look like, but looking at everything I see, I don't see any way out of it.
Fed's basically back into a corner right now. If it's going to keep the whole game going, we've reached that end game that you always do in fiat currencies, where sooner or later they have to hyperinflate it. Either that or it's game over at that point, because somebody sooner or later is going to not buy our debt. And I think a lot of that anxiety as we've moved out of the subprime mortgage crisis to where we are now is what has been driving this whole silver gain in silver and the other metals.
Precisely, yes.
Market seems to be moving towards more of a safety trade. It seems like bullion is gaining some preference over equities. I'm not sure why that is. Do you have any idea?
Again, I think in my last newsletter we talked about how the actual, say, gold metal has done versus an index, the S&P TSX Gold Junior Gold Index. And since 2006, gold's up about 190-odd%, whereas that index is up only 95%. The reason behind that is mining is a very, very tough business. There's always issues, be it political, social issues that slow down mines, cost overruns, the grade doesn't come in as it's supposed to, things break. Mining is a very tough business, and it doesn't work as smoothly as, say, a toothpaste company.
Right. And what usually drives the balance between equities versus the bullion itself? In other words, how is the slosh back and forth, so to speak?
Well, I think you're right. I think we're seeing risk-on, risk-off trades going on here. And now we're seeing the risk-off trade where people are going more into the bullion, the metals, and that sort of thing, and selling the high-risk junior explorers and miners.
Let's pursue the line of thinking that you just broached here, and that was on the whole issue of the juniors. If a number of these get taken down as we go, what does that mean for investment opportunity? Let's assume you're right, and let's pursue that.
But what's happened is there's been a lot of money raised, and we talked about that. Most of it ends up being wasted because the fact is Mother Nature has been very generous to the junior mining industry in that she's scattered geochemical anomalies all over the world. But there are very few of those turn out to be actual economic ore deposits. So these are being worked right now, explored by various companies with all this new money, and most of them are going to fail, but there are a few that are going to work, a few that are going to look good. And if we can focus on and identify the few properties that are showing the signs, the early stages of a discovery, that's the place to be. And with this market hit coming, and I think it's going to go through the summer, the people that put the money in really don't understand or differentiate between what is a good project and what is not going to make it economically. So, in effect, all of these companies are going to be taken down, the good with the bad. And if you've got a list of the good, that's a great time to be buying these things, because longer term, there's no doubt that the major mining companies have got to replace their depleting reserves with quality ounces or pounds in the ground.
especially considering the fact that demand is not going to quit. It may dipsy-doodle over time. As you make discernment between both of those types of companies, what are good measuring sticks ahead of time, assuming that you're going to make that investment?
I think it's critical, and again, just talking to the junior exploration companies,
right,
that an investor in one of these companies understands what the company is looking for, what it looks like, and be able to quickly evaluate results as they come in, being drill results or whatever, against the geologic model or the mine model to see if it's confirming or not confirming that the company is progressing the way it should go. That's really, really key in order to know when to get out early, because if you don't get out in time, it really, really hurts when the bad news come out. We saw that this week with a company called East Asia Mining and their project in Indonesia, where they put out a news release of 3 million ounces at a gram. But there are people on television talking this up to an 11 to 20 million ounce deposit. So you need to know what something really consists of, what the deposit consists of, and what the economics behind it are. That's really the key, and that's not easy, but that's what you need to do.
Piqued my interest because would you have some kind of an investment checklist that you would use versus listening to the hype or the talk that might be on the street?
Well, I certainly do. I've been doing this 30 years, so I sort of know what I'm looking for. To someone who's runs a grocery store or something like that, to try and discern between what's good and what's bad is a lot more difficult, and you really do need an advisor, an expert in the industry to rely on. A good analysis. And I think, secondly, go to their website, something anyone can do, and when a news release comes out, the company should give you all the data, all the drill holes, maps, sections, etc., in order for you to evaluate things. And if that's not being presented, that's a big red flag in terms of, well, there's a problem here. Either they're hiding something or they're incompetent. Either way, you don't want to own that company. So a company should put out all the information and be very receptive to inquiries from investors or potential investors. Call the company. That's what they're there for.
That's why I asked the question, was because does it require that high level of expertise? And if so, how does the average investor, like you say, the man who's running his own business or grocery store for whatever, how does he or she make that decision that they need to make that's critical if they're not experienced in it? Because you can't just replace a lifetime's worth of experience. But I guess that's why good newsletters are worth their weight in gold, too.
I guess that's kind of where I'm going, is hire an expert. And, I consider myself one of those experts. I wouldn't go to some website and, just look if I was going to get brain surgery and just pick someone out of nowhere or assume that I know anything about brain surgery. If you've got to have brain surgery, hire a brain surgeon. Not an accountant or a writer of some sort.
It reminds me of these ads on TV. You see these about, this gold coin was a special coin limited edition. Now you can have a gold clad whatever. And they're making this bait and switch. I go, why would anybody invest in that if you knew what you're doing? But somebody must be doing it because people are buying it,
I assume so, yeah.
Do you think quantitative easing, QE3 has been the big rumor. Obviously, we're in QE2, which Ben Bernanke's still trying to deny as being inflation, but I think we've accepted that it is. QE3 is just pretty much off the table for now. How much of that anxiety has been driving some of what we're seeing in the markets, whether we're going to have more inflation or not? Because you must admit, it really took up and kicked off as soon as we got into the quantitative easing.
Yeah, I think you're right. QE3 really hasn't worked that well, except in terms of getting money out into the speculators.
Yeah.
And so QE3 probably won't work, and they probably recognize that. And I listened to Bernanke's talk and interview the other day, and what I came away with is he's a little more concerned about inflation. I think that's something we know is coming, and they're responsible for. So I don't see an immediate QE3. At least I don't see them putting that in effect until the end of the year if they have to go for it. And then we enter the election cycle where they'll do anything to get the market and economy going, which is inflation.
Yeah, and once the perception is there, it's a question of how fast the perception of the investors, those in metals, perceive that QE3 or 4, wherever we're headed, is real. Depends on how fast the market reacts to it then, and then the differential in price on the metals. So, But for right now, we seem to be going into this transition period across the board, whether we look at safety trade issues or junior stocks, et cetera. This now in a transition now. It doesn't quite have the foam that it had before.
No, it doesn't. I suspect over the summer it's going to get worse, which, if you've got money to invest, is fantastic.
Yeah, now that the blow-off has pretty much occurred. Brent Cook, any closing thoughts? And don't forget some websites.
My website is explorationinsights.com. There's a number of free articles on there I actually made a video up in the Yukon where I evaluated a project that's worth having a look at if you're into this sort of thing. And I think caution is probably what I would really be stressing right now. And pick your entry point. Pick a good price for any stock you're looking to buy, because the odds are it's heading down to that.
All right, Brent, appreciate it. Hope you have a good week.
Thank you. You too.
You're listening to Financial Sense Daily Edition at financialsense.com.
Dave Morgan joins us next from the Morgan Report. And Dave, we've got to talk about what happened to silver. When we were on last time, we were talking about the thing was getting pretty parabolic and toppy, up 80% in 2010, and it was up almost 50% this year before the pullback. So one of the questions that a lot of people have on their mind is, I think, Dave, you know this more than I do. Didn't they raise like margin requirements 4 or 5 times?
Yes, they raised them several times. And, to be objective, I anticipated this move not to the level it got. I was getting cautious around the $38 level all the way up. Personally, for my trading account, I sold out around the 46 level. It was the day that it started to come down off a little bit. It bounced stronger the next day. Anyway, the point being that I was anticipating that there was going to be a further parabolic move. And one of the questions to members, only the paid people, was, what do you see? And I said, number one, they will raise margins. Number two, they will increase margins dramatically. And number three, I won't go into, I'm going to put it on the next month's report. But so one of my subscribers sent that back to me. He says, geez, you know the future. And I said, no, I don't. This is very typical of any commodity. I don't care what the commodity is. Take the word silver off the chart. Show me a chart that's up 80% in 4 months of last year and 50% in the first 4 months of this year. And I don't care if it's corn or soybeans or silver or, something else that trades on the futures market. There's going to be an increase in margin requirements. Now, how they did it or did they have to do it that much? Those are esoteric questions I don't have answers to. But what I do have answers to is that they were going to increase them, and they're going to increase them again and again. And this is exactly what happened.
It's amazing, too, because I might want to point out they've increased margin on the ag sector. They've increased, I think it was Monday this week, they increased margin on oil. And whenever you get a speculative froth building into a sector, once again, forget the name silver. What I think they're doing, Dave, and you remember what it was like during the summer of 2008 when oil ran up from 125, ran up to 147. I don't think they're going to wait this time to allow these things to get, if we learned anything from the excesses that we saw between 2006 and 2008 in the mortgage market, the commodity markets, and especially the credit markets, is you can't let things get so extreme. How do you know some hedge fund manager is in there and they're in a momentum trade, they're leveraged 50 to 1, and they're buying huge positions like, I'm trying to think, was it Amaranth that they owned all the contracts in the natural gas market in 2006? So anytime you get a parabolic move, from what I'm hearing from you, Dave, and from the experts that I've talked to, you're going to see the authorities come in and start raising margin requirements.
That's right. There were clues out there. I have this service I've had since January of 2010, so it's been for about a year and a half now, where I basically show people my charting and my thinking. I talk through the charts as I go through these things. And, copper was rolling over, and that's usually a pretty good leading indicator. I don't expect everybody on your show or our program today to know that. But I know that. It doesn't mean that I'm right 100%, but it's a very good indicator. All these things are tools. What concerns me, I guess, and did and still does, is that all these Johnny-come-latelys that, read 2 or 3 people that were, silver experts over the last 6-month time frame, and they read this stuff and they get very involved in the market only to get hurt. And I was saying, again, from the $38 level or so, I don't want to see anyone get hurt, and that's true. I'm really sincere about that. And people that are silver investors, the last place you want to be, is in a leveraged position.
And the thing that did it for me, Dave, it was a week. It was amazing because I've been taking futures. In the futures market where you're leveraged, as you know, on some of these contracts, 20 to 1 intraday, and you can be leveraged 10 to 1 at the end of the day when they settle accounts between 115 and 130. But there was a report that came out that said silver next move 80, just right around the corner. And I saw that. We started layering out of silver, and then we put in a put because you just know this. I don't care if it's oil, if it's silver. It could be gold. It could be corn. It could be copper. You know, when everybody's talking about this is a no-lose proposition, get in now. But that $80 silver price, I said, boy, this is getting a little bit goofy.
Yep.
Also, my son Chris did a piece. It was a 4 standard deviation, and you're technically oriented. Let's talk about Keltner bands, because whether you're looking at Bollinger bands or Keltner bands, it was like so far out in terms of standard deviations, in terms of the price bands. It was a clear warning that at any day something was going to crack.
Well, true. I mean, your son wrote a great article, and it was, I think, 4 Sigma was, so far outside any normal range that you would expect it. I did it just basically by experience. I do look at a lot of technical indicators. The way I actually trade, I don't really use a lot of the technical indicators. I think one of the best technicians on the planet is John Murphy. I don't know how John trades exactly, but I know he's got a very elegant way of looking at things, and he filters out a lot of stuff. I mean, I'm going to digress for just a minute here, Jim, and you're talking about taking a futures course, and of course I've been in that side of things for a very long time, not to the level I once was, but I still, do it. And I remember talking to a floor trader, a friend of mine, and he said, we're talking all these technical indicators and how many there were and how complex some of them are, and there's always a new one invented, and on and on. He was a Cambridge graduate, and he said, well, David, do you know why we have all these technical indicators, don't you? And I'm thinking, so we can get an edge on trading, And he goes, no, to impress the girls at the bar. And I say that with some authority, because basically the way I work the markets now is a Richard Russell approach, and I've never spoken with Richard directly, but I let the market tell me. If the market's going higher, it's going to go higher. I mean, it's not that complicated. Now, you want to be stupid about this stuff, and you want to use stops and everything else that goes when you're in a leveraged position. But I do not look at a certain indicator. There's a few I look at. I'm not going to divulge them over this call because people pay me for my insights, but it could be a lot simpler than people make it. People are looking for that perfect whatever. Now, coming back on point what Chris wrote, I mean, I did it just by experience and seeing the market. I didn't actually take a look at the Bollinger Bands and say, that's 4 Sigma, but I knew it, from 38 on up. You better be buying puts, which we recommended to our subscribers. I got 2 letters today, or 2 emails today saying thank you, thank you, thank you. I did protect my position, as you said. I did a little early, I thought. Today I cashed out big time, thanks again. That kind of thing. So I don't know what to tell you, Jim. Silver is one of the most emotionally charged, most volatile markets out there once it gets going. I mean, you got to look at it. If you look over at like the last 30 years, it was dead for 20. I mean, it basically just flitted around the $5 level, up and down, and above and below it for for 2 decades, basically.
Yeah, I can remember, Dave, when you first started coming on the program and you introduced me to silver in 2001. It was like it'd get down to 4, you'd buy, it'd get up to 5, you'd sell. And it was almost like, technicians would call this a consolidation pattern on the charts where $5 you sell, goes down to 4 you buy. And Dave, it was like that for the longest period of time. And then we had that very explosive move, was it 2005, where it hit 8 or 850 and just broke out of nowhere.
Yeah, it went to 840, and that was the Buffett purchase. Then it backed off again, and it touched 555 intraday, and then it went from 555 and started moving back up and broke through the 840 level. But you're right. And I was going all over the world, mostly the country then. I wasn't really asked to speak across the pond in those early days. But I was all through North America. And I was telling everybody, once this breaks this level, and it was the 555 level, no one knows how high is high. Now, that sounds kind of stupid, but it's the most honest statement you can make. I said, once it breaks, it's going to go. It's going to run. It's going to move, and it's going to go quite a bit. Now, if you do percentages, Jim, and you look at, let's say you bought it at 4 and it went to 840, that's a 100% move. If you bought recently at the breakout of, say, 20 and it went to 50, that's 2.5 times move. It was a lot safer, to be in a leverage position, in the 5 to 840 level, but still it crashed hard. In fact, there was a huge gap down on that sell-off. And I, again, told my people to get out at 720, and I got the hate mail, Jim. It's going higher. It did for 3 more days. And I wrote them back, not individually. I said, look, you can take it or leave it, but I've got a lot of experience in this market, and I've learned over time by losing money that the best thing to do is to sell into strength. You never want to have to sell when the strength is gone. Leave something for the next guy, and never, ever, ever try to pick an exact top.
And when you look at this, when you have these outside bands, let's talk about what the charts are telling us right now. We had a terrible week, and then we hit a low. We've bounced off that. But it seems to me, Dave, the next area of support is going to be somewhere in that $26 to $30 range. So I think those are the next critical levels to watch on the charts in terms of where the demand comes in that's strong enough. You'll see more buying, and we might point out right around $25-26. That was when Sprott started their silver trust, and there's enough of those trusts out there. You got Sprott, you got Nick Barashev's fund, you've got, what's the other one out there, Central Fund. So these guys are pretty sharp long-term investors, and when they see a bargain, don't be surprised that if we touch down at that level, they announce a new offering.
Yeah, exactly. I mean, I see, I know the round number game in commodities too. It doesn't always work, but I see the charts. I mean, 30 looks like a pretty good level of support. Will it break through 30? It certainly could. How far down could it go? No one knows, but I agree. I think 26-ish in the 26.50, I don't know, somewhere in that level. If it got there, I certainly would be a buyer. I'm planning to start buying physical again around the 30-ish level. Of course, I reserve the right to change my mind if I see something, come across the wire services or whatever. It'd have to be pretty significant. I reserve that right. But nonetheless, Jim, it's exciting, but I, again, feel some emotion. I don't even know what it is that these people that are coming in late and, especially with my service because, I have new people all the time and people write all the time. And, well, I got in at 37. Do you think I should sell now? And this and that and the other thing. And, my fundamental focus on why the precious metals really are a subset of my mission statement, which is to teach and empower people to understand the benefits of an honest financial system. I mean, my thinking goes way beyond the precious metals arena. It's just that the precious metals is the only area that I know of historically and as a statement of fact, empirical evidence, that you can be in on a cash-paid basis that's going to preserve what you have or actually maybe in real terms, and so far in real terms, make you wealthier. But this isn't true capitalism. I mean, I'm a true capitalist, a real free market type, and, I want to see the future brighter, better for everybody, and that means by the human mind, by making inventions and innovations that help all of society, and the people that do that type of thing get wealthy for doing such. And not to say that we don't have innovation in America, but believe me, Jim, from the study that I do, and I know you read as much as I do, we've certainly been on the decline. It was one of the themes that we talked about when you first had me on your show. The East is building up, the West is coming down, and, this commodity sector has been driven a lot by speculation. I mean, China's having issues right now, and I don't think the China story's over, but that no one goes from A to B in a straight line. It's going to take some backing and filling. It's going to take some rough sledding, and I think China's in for some of that.
I couldn't agree more. Dave, so in terms of last time we had you in the show, I know a lot of people, the thing I didn't like seeing was the huge premiums that we were seeing in the coin market. It was bad enough that the price of silver it spiked to that level, but when you add the premiums on for silver eagles or maple leafs, and at that time we talked about that the better value if you were buying in the physical market, and both you and I have not been buying, that the better bargain was the junk silver. So let's talk as we conclude about junk silver. Do you still feel that if you do want to buy bullion, that's probably your safest bet?
Right now, it still is. You bet. And again, it's a bit cumbersome, but I've always taught, and I still have the same belief that it's a good way to start, and it's very recognizable. They are a bit cumbersome, but once you get a bag of junk or a half bag, I recommend anyone that's got a fairly decent net worth to buy one bag of junk silver for a household. That would be enough change to barter in the worst case, which I doubt you'd have to, but you could. And it's a good, solid way. And there's a big market for that. I mean, buying a bag of junk, as it's referred to in a trade, is easy to buy and easy to sell. There's always demand for it.
Couldn't agree more. Well, listen, Dave, as we close, tell our listeners about the Morgan Report and your site and what's on it.
Okay. The best way to get there is on the Internet, of course. It's an Internet business, and it's silver-investor.com, or you could use themorganreport.com. Both places, or both URLs, gets you to the same place. And also, Jim, I want to point out my other little web page, which is silver123.net. That's silver123.net. That has a video I did quite some time ago showing a liquidity squeeze on the U.S. dollar. It's an interesting little video. And then on top of that, there's a Silver Saver logo on the far right-hand side. It's hard to miss. It's pretty good size. That's a monthly accumulation program, and it's really designed pretty much for the small investor, and pretty much still is, but they have dropped their margins, and their margins are very fair, by the way, and I am involved in the program myself. But if you're a big investor and you want to, time the market, or you decided you're going to put in, several $1,000s over the next 6 months or so, give these guys a chance to make an offer on their product, because they've really squeezed down the margins as much as they possibly can. Now, I'm not saying they're the best dealer. That varies daily. I mean, and getting the best price isn't always the best deal. If you've ever read my 10 Rules of Silver Investing that you can get on the website for free, you don't have to pay me for that anymore. I've given that out to the public for free for the last 5 or 6 years. You'll see that, you don't want to get a raw deal from your dealer. That's one of the 10 rules that I have, and I go into that in depth in those free rules of silver investing. So, bit talking about the end there, Jim, but thanks for letting me give out that information.
All right. So as we conclude, Dave, just for our listeners, you could see some strong support come in. It's silver somewhere around 30, but very strong support at around 26.5. If you do want to buy bullion, right now the best bargains are in junk silver. That's
right. If you're, brave, or you understand the fundamentals, nothing's changed on the dollar issue, the real problem, then you can start a dollar cost averaging program with the Silver Saver program, kind of put in an autopilot and relax. Good advice. As always, Dave, listen, thanks for coming on the program, and great speaking with you again. Thanks, Jim. Always a pleasure.
You've been listening to the Financial Sense News Hour with Jim Poplava. The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell securities. Responses to listener inquiries are based on the opinions of Jim Poplava and do not take into account listeners' suitability, objectives, or risk tolerances. You should always consult a qualified financial advisor before making investment decisions. Financial Sense will not be liable to anyone for financial losses resulting from companies profiled or information provided on this program. The Financial Sense News Hour was produced by Steel on Steel Productions. Join us again throughout the week for more in-depth news and financial analysis at financialsense.com.